Buy, borrow, die. This is one of the greatest financial lessons I've ever learned as a financial expert. And if you're not doing this, you're missing out on one of the greatest wealth creation strategies of the 1%. You see, the wealthy are playing by a different set of rules, and they've mastered this maneuver that is so powerful. It is the difference between wealth that vanishes and building lifetime wealth for your family. And in this video, I'm going to unveil this strategy and give you the step-by-step breakdown on exactly how it's done and how you can implement this in your life to build tax-free wealth. All that plus more on today's episode. What's up, family? Welcome back to another episode of Tax-Free Living. I'm your host, Carter Cofield, CPA. I've helped clients save over $10 million in taxes, and today I am here to help you. So today we're going to be breaking down one of my favorite financial strategies, which is buy, borrow, die. The first question that many of you all have when you read this title is, what is it and how does it work? But before I can explain the strategy, I need you to understand this scenario and this insight about money. You see, the difference between wealthy people, middle-class people, and poor people is not how much money they make. The difference between wealthy people, middle-class people, and poor people is what they think the purpose of money is for. You see, poor people think the purpose of money is to get it, to give it to somebody else. So they make just enough money to pay their bills and they pass that money right on. They never keep any for themselves. Middle-class people think the purpose of money is to use money to buy things to impress people they don't even like. So they end up buying the car they can't afford, they end up buying the house they can't afford, and put themselves in massive debt, and they do this to impress people they don't even truly care about. Now, the wealthy understand that the purpose of money, and the only purpose of money, is to use that money to make more money. The purpose of money is to take it and to multiply it so that it can make you more money. So your money is always working harder for you than you work for it. And to understand the buy, borrow, die strategy, you need to first understand that principle of what money is for. Now that you understand that, let's break down the strategy. So the buy, borrow, die strategy starts with the most basic step, which is buy. You see, wealthy individuals, they put their active income and they use their active income to buy passive income. So they buy assets that rise in value over time. This can be stocks, this can be real estate, this can be crypto, it can be other businesses. So they buy assets that appreciate and they hold on to those investments for the long term. And the main question I get when I bring up the buy part of this strategy is people say, okay, Carter, well, how long should I invest? Like, when should I sell the asset? And the answer is never. And then when I tell them that, the next question is, okay, Carter, well, if I never sell the asset, how do I get access to the money when my asset grows? And that is a phenomenal question. And that brings us to the next part of this strategy, which is borrow. You see, by borrowing against the value of appreciating assets, you are allowed to unlock that cash without triggering a taxable event. Why is this? That is because the IRS does not consider loans to be taxable. So that you can borrow tens and hundreds and millions of dollars and pay zero taxes on the money because loans are not taxable. And this is exactly how billionaires like Elon Musk and Jeff Bezos can live these luxury lifestyles with such low tax bills, because they live off of borrowed money from their assets. Now, I know some of you are like, okay, Carter, well, if they borrow all this money, don't they have to eventually pay off this debt? Like, they can't borrow money forever, right? And the answer is, you're right. And this is where the third part of the strategy comes in. This is where the die part of the strategy is so essential. Now, some of y'all hear the word die like, Carter, this is a little bit dramatic, but hear me out. Death sucks. But there are two amazing things that happen when you die. Number one, when you pass away, your assets get what's called a step up in basis when they're passed on to your children, okay? Now, what does step up in basis mean? Think of it as the IRS giving your children a clean slate from your previous tax bill. So how does it work in today's practice? Let's say you bought a home for $100,000 20 years ago. And let's say at the date of your death, that home is now worth $1 million. So now you're gonna pass down this $1 million home to your children. Now, most people would assume that the ownership is changing hands, that $900,000 in capital gains, somebody has to pay it, right? Because the property is now worth $1 million when it changed hands. But if you structure this correctly with the revocable living trust, you are able to pass down this $1 million property and your kids get what's called a step up in basis. So your kids receive the property at the fair market value of $1 million, but guess what? That $900,000 capital gains taxes that they were gonna have to pay on that $900,000 of appreciated capital, it's wiped clean. So instead of having $180,000 capital gain tax bill, they now have a $0 tax bill because that property got what's called a step up in basis. Now, some of you all are thinking like, okay, Carter, that solves the tax problem, but what about the debt problem? Because if you borrow $100,000, $200,000, $400,000, $1 million, if you borrow $1 million of your assets while you're alive, somebody has to pay down that $1 million debt. And again, you would be right. Now, this is where life insurance comes in at the die part of this strategy. So when you're alive and you're borrowing the money against your assets to live off of, during this time, you also want to purchase a life insurance policy that is equal or more than the outstanding debt that you plan to receive. So if I know I'm gonna borrow $1 million from my assets to live off of, I'm gonna buy a life insurance policy that has $1 million plus death benefit. Why am I gonna do that? That way, when I die, that $1 million life insurance proceeds goes down to my children. And in case you didn't know, life insurance proceeds are 100% tax-free. So now my kids can receive this $1 million life insurance proceeds tax-free, and they can use this $1 million to pay off the debts that I lived off of. So not only are we passing down tax-free assets to our children, but we'll also be passing down debt-free assets to our children. And this is why the buy, borrow, die strategy is so important and strong, because you literally get to not pay taxes when you're alive. Your kids don't pay taxes when they receive the assets, and the assets are received by your children 100% debt-free if you do this strategy the right way. Now, some of y'all are thinking like, Carter, this sounds good in theory, but has this actually been done? And the best way I can do is by giving you all a real life scenario of one of our clients. As you all know, we own a tax and advisory firm, and we help clients save on taxes and build wealth. So one of our clients, amazing gentleman, right, owned about $10+ million in real estate, a great real estate portfolio. And over the last 5 years, he has been borrowing substantially against his real estate portfolio. So although his real estate portfolio was worth about $10 million, he borrowed about maybe $2.5 million against that portfolio in the last 5 years before he passed away. So he had a $2.5 million outstanding debt on this $10 million real estate portfolio, but he was able to live off this $2.5 million debt tax-free for the last 5 years of his life. Now, when this client passed away, because he was working with a money team, his revocable trust was structured the right way, his LLCs were structured the right way, his properties were structured the right way, and his life insurance policy was structured the right way. So he actually had a life insurance policy with the $3.7 million death benefit. So, number one, when this client passed away, his kids received a step up in basis on his real estate portfolio. Now, of this $10 million real estate portfolio, the cost of acquiring this real estate portfolio was about $2.2 million. So he was able to acquire this real estate because he held it so long. He bought it for $2.2 million, but it was worth over $10 million. So now his kids got a $7.8 million step up in basis because all of his properties went to his revocable living trust, and his kids were the beneficiaries of his revocable living trust. So he got a $7.8 million step up in basis, which wiped out his tax bill from being passed on to his children. That's number one. Number two, again, he had a $3.7 million death benefit on his life insurance policy. So although the property, when they were passed down, they still had $2.5 million of outstanding debt against these properties. properties. So what did his children do? When they received the $3.7 million in death benefit from his life insurance policy, they used $2.5 million to pay off the debts. So now they received the $10 million portfolio tax-free, and they also received the portfolio debt-free. And guess what? They still had $1.2 million in tax-free life insurance proceeds to split amongst the children. Not to mention a $10 million real estate portfolio that cash flow, because now that the real estate has no debt against it, all the money the real estate portfolio makes is cash flow for his heirs. And if his heirs do right by this portfolio, if they do right by the money, this portfolio could be worth $20, $30 million by the time they pass away. And guess what? We're gonna rinse and repeat, and we're gonna rinse and repeat this system so that over time, the future generations actually get more wealthy by implementing this strategy. And the major takeaway I want all of you all to have is that this strategy is not solely reserved for the ultra wealthy. You can do this too, but you need to, number one, believe it's possible, and number two, align yourself with a financial team that can help you achieve your financial dreams. And if you're looking for a money team, as you all know, we do all these services in-house. You can click the link in the bio of this description of this video if you want to book a call with our team. But if not, please do me one favor. Hit that like button, hit that subscribe button, and please share this video with somebody that you know needs to see this. Because if they implement this wealth strategy, not only would it change their lives, but it will change the lives of future generations to come. And that's the goal of this channel. So again, if you like this video, hit that like button, smash that subscribe button, and I'll see you all next time. Peace.